Hello and welcome to the Tellone Perspective. I'm Dean Tellone. If you've been listening to this series, you know we've covered everything from building a career to proactive tax planning. In our last episode, we talked about where the real estate market is headed. Today, we are going to get very practical. We are going to talk about the actual mechanics of buying a house. Specifically, we are going to walk through the mortgage process. For most people, getting a mortgage is the largest financial transaction of their lives. It can feel overwhelming. There is a mountain of paperwork, a whole new vocabulary to learn, and a lot of money on the line. But here is the truth. The mortgage process is actually very logical. Once you understand what lenders are looking for and how the steps fit together, the anxiety disappears. Today, I am going to walk you through the process from start to finish. We will cover pre-approval, the difference between fixed and adjustable rates, what exactly goes into closing costs, and the 4 things every lender looks at before they hand over the money. Let's start at the very beginning. Before you even look at a house, you need to understand the difference between pre-qualification and pre-approval. A lot of people confuse these two terms, but they are very different. Pre-qualification is an informal estimate. You tell a lender how much you make and how much debt you have, and they give you a ballpark figure of what you might be able to borrow. They don't verify your documents, and they usually don't pull a hard credit report. It is a helpful starting point, but it doesn't carry much weight when you make an offer on a house. Pre-approval, on the other hand, is a formal process. The lender pulls your credit. They verify your W-2s, your tax returns, your pay stubs, and your bank statements. If everything checks out, they issue a conditional commitment letter stating exactly how much they are willing to lend you. If you want a seller to take your offer seriously, you need a pre-approval letter. It shows you are a qualified buyer who is ready to close. So, how do you get pre-approved? What exactly is the lender looking for? In the mortgage industry, we talk about the 4 C's of underwriting: credit, capacity, capital, and collateral. Let's break those down. The first C is credit. Your credit score is the single most important factor in determining your interest rate. For a conventional loan, you generally need a minimum score of 620. For an FHA loan, which is backed by the government, you can often qualify with a score of 580, provided you put down 3.5%. The higher your score, the lower your interest rate will be, which can save you tens of thousands of dollars over the life of the loan. The second C is capacity. This is your ability to repay the loan. Lenders measure this using your debt-to-income ratio, or DTI. They look at your gross monthly income and compare it to your monthly debt payments. Things like car loans, student loans, minimum credit card payments, and your projected new mortgage payment. Generally, lenders want to see that your total debt payments take up no more than 36 to 43% of your gross income. The third C is capital. This is the money you have saved for a down payment and closing costs. Lenders also want to see reserves, money left over in the bank after you close, usually enough to cover 2 to 6 months of mortgage payments. It shows them you have a safety net if you lose your job or face an unexpected expense. The final C is collateral. This is the property itself. The lender will order an appraisal to ensure the home is actually worth what you are paying for it. If you default on the loan, the lender needs to know they can sell the house and recoup their money. Once you are pre-approved and you find a house, you have to choose your loan type. The biggest decision you will make is choosing between a fixed rate mortgage and an adjustable rate mortgage, or ARM. A fixed rate mortgage is exactly what it sounds like. The interest rate is set when you take out the loan, and it never changes. Whether you have the loan for 15 years or 30 years, your principal and interest payment remains exactly the same. It offers predictability and peace of mind, which is why it is the most popular choice for home buyers. An adjustable rate mortgage works differently. It starts with a lower interest rate for a fixed period, usually 5, 7, or 10 years. This is called the introductory period. After that period ends, the rate adjusts annually based on a broader market index. If you take out a 5/1 ARM, for example, your rate is fixed for the first 5 years, and then it adjusts every 1 year after that. If market rates go up, your payment goes up. If they go down, your payment might go down. ARMs do have caps that limit how much the rate can increase at any one time and over the life of the loan, but they still carry the risk of higher payments in the future. An ARM can be a smart choice if you know for a fact that you will sell the house or refinance before the introductory period ends. But if you plan to stay in the home long term, a fixed rate mortgage is usually the safer bet. Now, let's talk about the final hurdle, closing costs. A lot of first-time buyers are shocked when they see their closing costs. They save up for the down payment, but they forget about the fees required to actually finalize the loan. On average, closing costs run between 2 and 5% of the home's purchase price. So if you are buying a $300,000 home, you should expect to pay between $6,000 and $15,000 in closing costs. What exactly are you paying for? It is a long list. You are paying the lender an origination fee for processing the loan. You are paying for the appraisal and the credit report. You are paying for a title search and title insurance to guarantee that the seller actually owns the property free and clear. You are paying recording fees to the local government. And then there are the prepaid expenses. The lender will usually require you to pay for a full year of homeowner's insurance up front. They will also collect several months of property taxes to establish your escrow account. By law, the lender must provide you with a loan estimate within 3 business days of receiving your application. This document itemizes all of these estimated costs. Then, at least 3 business days before you close, you will receive a closing disclosure. This document shows the final exact costs. You should compare the 2 documents carefully to make sure there are no surprise fees. The mortgage process requires patience. There will be moments when the lender asks for a document you've already sent, or requests a letter explaining a random $50 deposit in your checking account. It can feel intrusive, but remember, they are preparing to lend you hundreds of thousands of dollars. They have to be thorough. If you keep your credit clean, avoid taking on any new debt while the loan is in process, and respond to your lender's requests quickly, you will get to the finish line. And when you finally sit down at the closing table, sign that stack of papers and get the keys to your new home, all the paperwork and the waiting will be worth it. Thank you for joining me today. I hope this guide helps demystify the mortgage process for you. I'm Dean Tellone, and this has been the Tellone Perspective. I'll see you next time.